The U.S. economy has continued to recover, but economic activity appears to have decelerated somewhat during the first half of this year. After rising at an annual rate of 2.5% in the second half of 2011, real GDP increased at a 2% rate in the first quarter of 2012, and available indicators point to a still smaller gain in the second quarter. Conditions in the labor market improved during the latter part of 2011 and early this year, with the unemployment rate falling about a percentage point over that period. However, after running at nearly 200,000 per month during the fourth and first quarters, the average increase in payroll employment shrank to 75,000 per month during the second quarter. Issues related to seasonal adjustment and the unusually warm weather this past winter can account for part, but only a part, of this loss of momentum in job creation. At the same time, the jobless rate has recently leveled out at just over 8%. The recovery in the United States continues to be held back by a number of other headwinds, including still tight borrowing conditions for some businesses and households, and, as I will discuss in more detail shortly, the restraining effects of fiscal policy and fiscal uncertainty. Moreover, although the housing market has shown improvement, the contribution of this sector to the recovery is less than has been typical of previous recoveries. These headwinds should fade over time, allowing the economy to grow somewhat more rapidly and the unemployment rate to decline toward a more normal level. However, given that growth is projected to be not much above the rate needed to absorb new entrants into the labor force, the reduction in the unemployment rate seems likely to be frustratingly slow.